Generally, if I had an opportunity to sit down and send you a note following one of the best quarters the US markets has experienced in over 2 decades, that would be an easy and enjoyable letter to write. But as I sit here trying to lay out this message to you, I struggle with what the right tone should be. As it relates to your investments, we're in a better place today than we were 3 months ago. But what direction do we go from here? With regard to the virus, the case count continues to rise, but the death rate has plunged, meaning more and more people that contract the virus are surviving. So while we could talk about all the positives that have happened over the last quarter, there are still significant headwinds that need to be given their proper attention as well. Just as I spoke to you 3 months ago about the speed of the drop in the markets, the recovery has been equally as fast. The S&P 500 has gained approximately 25% in the second quarter, leaving the index still down about 4.5% for the year, and about 10% down from its February highs. So while we have seen a strong recovery to this point, we still have a ways to go to put the drop in the markets behind us. The question is, when will that happen? Over the next 6 months, we should continue to see high levels of volatility, days with strong good performance as well as negative performance. With the level of uncertainty as to the path of the virus, the time to a vaccine or improvement in therapeutics, the reopening of the economy, and the consumer's ability to take part in that reopening, the return to work of those that have been displaced, and what a return might look like for those that have been working remotely for the last couple of months. If we stretch that timeline out further and look 12 to 18 months down the road, it is likely that volatility remains, but with better direction as to the path of the recovery and what our new normal looks like. Keep in mind, and I'm sure the media will not let you forget, that we also are going to be having an election this fall that could drastically change the path of the markets as well. With all of that information, you may ask yourself, what is there to look forward to? And how do you remain comfortable with the plan that we've helped you put in place? You can start with the fact that you have taken the time to put a formal financial plan together. With your plan in place and your follow-through on taking our review meetings, we can continue to ensure that you are properly positioned for whichever stage of life you find yourself. Your investment changes and decisions should continue to be driven by that plan, not by the noise going on all around us. No one can determine the track of the stock or bond markets. Missing out on the best days of the market does significantly more damage to your account than missing out on the worst days. Time in the market will continue to be your best long-term driver of return as compared to trying to time the market. As we move forward, there are 2 certainties that need to be dealt with. First, in 2026, the individual tax rate decline that was a part of the Tax Cut and Jobs Act will sunset, and all rates move back to their 2017 levels. This is the written tax law as we know it today, and it will take a new law change to alter it. With the level of government stimulus used over the past couple of months and the additional spending that is being proposed, it is highly likely that we will see taxes increase further and potentially sooner than it is written right now. For that reason, continued and proactive planning regarding the amount and timing of the taxation of your assets needs to be a driving force in your financial plan. Remember, when you move into retirement, it is not as important to focus on how much you have. You need to focus on what you get to keep. Tax drag on a portfolio is going to be a detractor of return moving forward if you do not take a proactive approach to your plan. The other certainty that we need to be aware of is that bank and money market assets will not have the ability to keep up with inflation. So while the number of dollars and cents that you have may be protected, their value, and more importantly, your ability to purchase goods and services with those same dollars and cents will decrease. In April, bank deposits grew by $685 billion, which is more than has ever occurred in a full year. Well, that's great news that people have taken to improving their savings during this period of certainty. This will be a significant negative to your financial future if not addressed. The old 60-40 model is dead. General bonds will struggle to offer actual return as we again move off of a near 0% federal funds rate to something that is higher than that in the future. We need to ensure that the data of the past, high amounts of bond holdings, using CDs as retirement income, do not overshadow the realities of the present and the possibilities of the future. Income planning as it was done 20 years ago is not wrong in general, but it is wrong and will not work in this interest rate environment. Just as we work to continually mold and shape the investments that we use, we need to continue to mold and shape our approach to income planning, as the tools of the past will block your path to a successful retirement. As always, if you do have questions, if you want to take this broad, general message and talk about how it specifically impacts you, your financial plan, or if you have friends or family that would like to find out how they can also take control of their financial future, please reach out to your primary advisor here at Midwest Financial Group, to myself specifically, or any of our staff, and we'll be happy to discuss. We are committed to keeping all lines of communication open and can meet in person as needed, set up a digital meeting via Zoom, or simple phone call. Whichever you prefer, we will be able to accommodate, as it is you that we are here to work for. So as we move through the summer, stay safe, stay healthy, and stay in touch.